Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So using that similar methodology, I take my portfolio size divided by the ISE value times 100, which is 11,313 at that moment. And then I could just do some simple algebra to say 250 divided by 11,313 equals whatever, some value in the future, my portfolio value divided by the new ISE value, the new exchange rate. This is the projected exchange rate of 126.26. So I'm trying to solve for what would that portfolio, that purchasing power. And of course, the purchasing power would be significantly increased from the U.S. dollar standpoint and significantly decreased from the Canadian dollar standpoint. So the new relative value would be the dollar, the U.S. dollar would gain almost a similar amount than what we lost the last example. So it would now be worth $279, or about $29,000 higher. Or the Canadian would lose $29,000. So hope you follow me on this. First, most important, remember, we're worried about having money, let's say, in Canada, Canadian investments, and that the Canadian currency might weaken. So I'm going to look at call options, and I'm going to look at, let's say, the most expensive, at least in this example, 103s for 13. The 108s for 9, 113s for 6, 118s for 370, and then the cheapest, the 123s for only $2.20. So what happens if the value goes, let's say that we're, based on this hypothetical example, that we get up to 126.26, well, we come up with 23.26 all the way down to $3.26. So that's what would be worth. Clean that up. And then I take my value less my cost. And I want to figure out my call increase. So I just multiplied it by 22 contracts. So that's how much I'm benefited by buying the call option. So where did I get the biggest bang? Well, in nominal terms, it's going to be the 103 call. But I paid the most. So I get back, I profit $22,572. I lose $29,000 in my currency exposure, my Canadian currency exposure, so I lose about $6,000. So you can see that I can go through all of the different examples and lose up to almost 27 or 26,683, 18,983. If my math is right, which I hope it is, I could come up and find that the greatest losses will be in the out of the money options because I bought a hedge that didn't hedge me for a long while. If I bought a 123 hedge, I don't get any hedge until I get to 123. So that's why, if you look at it, let's go back to our little price chart. Just clean this up. The 123 hedge is nice because I'm only paying a very small amount for that. Problem is that 123 doesn't give me any hedge at all until I roughly get right in here. That's when my hedge kicks in. But I'm down here at 113, so as the dollar, if it does indeed rally, I have really no hedge until it gets to 123. If I wanted a sort of an immediate hedge, I would buy the 107, but that would give me an immediate hedge, but that would cost me more money. So it's always about risk and reward. So remember, if I'm worried about the dollar selling off, I'm looking at buying put options. I multiply the ISE value times 100 to come up with what that contract is really worth. So let's say $11,000 roughly. And then I figure out my portfolio size, figure out how many contracts I need, and then I could just do, I could put that trade on as such. So the strike price selection, there's nothing magical about it. It really comes down to the amount of risk that you're willing to take. Deep in the money options, as I showed you, are going to hedge a lot more of your exposure. But one thing you need to think about, if I'm going to buy a very, 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 very deep in the money option, what's the point? I'm probably just paying a little bit more than the intrinsic value, and I'm just going to basically now have a position where I'm hedging my position. But if I'm fully certain I want to hedge it at that very, very high rate, if you will, or very, very low rate, depending if it's a call or put, I might want to just sell the spot market and just get out of the trade it in the spot market and close it out. Of course, there are futures available. The options market gives you a lot more choices. So different strike prices depending on where your level is. In fact, I talk to a lot of importers, exporters, and they always tell me there's a certain pain level that they feel, whether it's 105, 100, or 120 or 125, depending on who they are and what their business is. That might be an area that they might want to buy some options to lessen that pain level or hedge out their currency exposure. So deep in the money options can hedge most of it. At the money will give you sort of a balance, a bit of a hedge, and the out of the money options don't really hedge at all. As I said, if you're trading 111 and you're buying a 123 hedge, you're really buying catastrophic insurance, because unless there's a major, major move, you're not really going to get any benefit there. But again, we've seen catastrophes happen before, especially in 2008. So I'm not completely dismissing that 123 call. Longer-term options can be purchased. The good thing about that is you pay less per day, less theta risk. Shorter dated options, let's say that you're only concerned about a month or two, they will have a lot lower cost. Another idea, though, is that you can actually buy a longer dated one, and if you decide you don't need it anymore, you can just sell it. Ultimately, investors must consider both these alternatives and maybe some sort of period in between. Why would you hedge? Well, just remember, you're never fully certain of anything. And at least I learned that almost day one of my trading career, is that no matter how certain I was because of a certain setup or whatever, I'm never even approaching a 90% confidence on anything. So forget about 100. Options give you the ability to hedge various exposures. So deep in the money puts are going to be able to, you'll be able to hedge your U.S. dollar exposure if you're worried that the dollar is going to sell off. Deep in the money calls are going to also give you sort of that hedge, but again, that's if the dollar rallies so much and the opposing currency, in this case the Canadian, weakens so much. The out of the money options create an embedded stop loss at the particular strike. So calls or puts, that out of the money option creates this embedded stop loss.